Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to personal finance, real estate, investing, the markets, and all that sort of stuff. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But today I want to talk about debt.
No.
More specifically, I want to address the notion that paying down debt is some sort of risk-free investment. The idea is that if you have some cash and you have some debt to pay down, you use that cash to pay down the debt, then you get a risk-free return equal to the rate of interest that would have been on your loan. However, that is only partially true. It's not telling the whole story. Now, it is correct that when you pay down debt, you are going to get a sort of guaranteed return that's equal to the rate of interest. For example, if you have a loan for $100,000 at 3% interest, then you are going to be paying $3,000 in interest every year that you don't have that loan paid off. If you get some lump sum of $100,000 and use it to pay down that debt, it's as though you're earning $3,000 per year in interest back as a sort of return, since you wouldn't have to pay that because the debt's gone. That all makes sense. It's pretty easy to understand. The return that you're making is the interest that you're saving by not having the debt anymore. However, there is a risk associated with paying down any debt, and that's the risk that you are foregoing returns that would be higher than that rate of interest that you're paying down. Or put another way, it's the opportunity cost of using that money for something else. Just like any investment, paying down debt should be looked at through an opportunity cost lens. What is the cost of paying down this debt? What could I have used this money for some other thing that might produce a higher return than the rate of interest? It probably would help to take a look at an example. Let's say you have that same $100,000 loan from before that has a 3% annual interest rate, very low, but actually kind of common nowadays with the super low interest rate environment. But let's say you have that loan, maybe it's a giant student loan that you had at a really low interest rate, and you're wondering what you should do with this giant cash payment that you got because you had a rich relative die, left you with $100,000 in cash, and you're in this situation where you have $100,000 in debt and $100,000 in cash. What do you do? Well, you could take the guaranteed return and pay off all that debt and basically make a return of $3,000 per year, 3% return. Or you could take that same cash and invest it in something that produces you a 7% annualized return, netting you about $7,000 per year. Now that $7,000 is greater than the $3,000 that you would have saved by paying down the debt. Now that's a difference of $4,000 in just the first year, 4%. And that 4% is going to compound over the many years that you would have that invested compared to just paying down the debt. The returns compound just like any other investment. So in that situation, it looks like paying down the debt early was arguably a bad decision because you could have made much more money by holding on that debt, just making the minimum payments and investing all that cash into something else that would produce you a return higher than 3%. Now, I'm no financial advisor, and this video should not be taken as financial advice, but that example we went through is still a little simplistic because we have to understand the risk-reward trade-off of any investment. The higher the expected return of an investment, theoretically, the higher the risk associated with that investment is. So there's a risk-reward trade-off. Same thing with debt. You're going to have a little less risk when you're paying down the debt because it's a guaranteed return. You know you are going to be saving that interest. So the sort of variance that you have might be a lot less. You know you're getting that guaranteed return. However, conversely, you don't know how much you could have earned by investing that cash elsewhere. So that certainty is kind of a weird paradigm. You have, on the one hand, you are certain that you're going to be making this return, but on the other, you're completely uncertain about what return you actually could have made had you invested that cash elsewhere. However, there's one thing that we're definitely overlooking here when we're talking about debt, and that's freedom.
What will you do without freedom? Will you fight?
When you don't have any debt, you don't have any payments, and you don't have any obligations to other people to pay them. So in the event that your other investments fail or you run out of money for some reason and you can't service the debt payments for that other person, all of a sudden you are in a big predicament. You're not going to have the money to pay down that debt. The creditor is going to come after you. They might foreclose on something if it happens to be attached to real estate. They might start some sort of court proceeding against you to collect, take your car, take whatever they can get their hands on to pay back the balance. That is very stressful, and it is always a risk when you have any amount of debt. There's always a risk of default. And default is an ugly thing, and that's going to be hanging over you if you are not careful. And even if you are careful, it is always at least somewhat of of a threat. Now you might counter with, well, I keep a lot of cash reserves, so I can always cover my debt in a pinch. Well, at that point, why don't you just take that cash and pay down the debt? Now, I get having reserves is important when you have any amount of debt, but that's a cost there too. That cash that you have sitting in reserves isn't being used as productively as it could be in some other investment that could net you a higher return, or even being used to pay down the debt if you're making less than whatever the interest rate is on that money. The point is, there's an opportunity cost whenever you use your money in any way. You could always use it in a different way. What is the cost of using your money in a particular way versus another? Just keep in mind that it might be a little hard to quantify how paying down debt will actually benefit you and whether it's actually worth it to pay down that debt, because freedom is a very arbitrary thing. Well, I shouldn't say arbitrary. What I really meant to say is that it's hard to pinpoint an exact value on gaining freedom. Now, like love, as Matthew McConaughey explained in Interstellar, it is quantifiable.
Love, Taj, love. It's just like Brand said. My connection with Murph, it is quantifiable.
Now, like love, freedom is something that can be quantified, but it all depends on how you view it, since no one can tell you how much freedom is worth to you. That is up for you to decide. But I hope this helps you to look at debt and paying down debt in a different way, and hopefully a more useful way when it comes to actually making financial decisions in your life. Because your debt has a cost to keep open, but your debt also has a cost when it is paid off using some cash from somewhere else. You can invest that cash in another place, and maybe that cash could have earned a much higher return had you let it ride in some other investment. But at the same time, you wouldn't get all that freedom that you have by paying down the debt and getting rid of it, since that is very liberating and does have true value. But anyways, that's all I've got for today. If you like this video, please like it, since it helps the channel out a lot. If you like this sort of content about personal finance, investing, the markets, and all that sort of stuff, be sure to subscribe so you don't miss any of my new updates. I have a few series about my personal ventures as well and how I'm investing, both through the thick and thin of the up and down markets, so definitely subscribe so you don't miss those updates. But let me know in the comments down below what your plan is for using debt, whether you are all in on using a ton of leverage to maximize your returns, or whether you are extremely cautious and you never use debt, or you always try to pay it down. Love to get your perspective in the comments below. And also take a look at my links down in the description below. Got some free stocks there for Webull and Robinhood if you open up accounts with either of those using my affiliate links below. But otherwise, until next time, take care.